Welcome, everybody, to another episode of Smokin Bulls, the podcast about business, money, and lifestyle. I'm Tyler.
I'm Dave.
And today in studio, we're joined with Mark Rarog. He's the Chief Investment Officer and Head PM over at IAS Solutions at Wellington-Altus Private Wealth. Mark, thanks very much for being here.
Glad to be here.
And we do a lot of these by Zoom or Google Meet or Microsoft's Teams meetings, but this is awesome to have somebody right in the studio. So thanks again for being here.
Yeah, happy to be in town.
So if you don't mind, maybe we'll kind of kick it over to you just to do a bit of an introduction of maybe a little bit about who you are, as well as who IAS is and the stuff that we might be able to find in there, just so our viewers know, what we're talking about today.
Sure. Okay. My role, you kind of mentioned, Co-Chief Investment Officer and Head of the Multi-Asset Solutions at Independent Advisor Solutions. My background, I spent 19 years as an institutional portfolio manager at one of the largest asset managers in the country. I managed, again, a few $1 billion in North American equities. I also ran global natural resources for several years. And as head of equities, I also had oversight over approximately $10 billion of assets at that shop. Coming to Wellington-Altus, we just started our own independent fund manager, and that is named Independent Advisor Solutions. And that is a nod to really our mantra here, where we are not managing assets internally. We're not rebuilding the wheel here. We believe in a sub-advised model where we find and hire the best of the best in terms of managers. And then we construct portfolios and again, model solutions. We're big believers in that and have oversight over the asset allocation. And again, currently, I guess I am the portfolio manager responsible for about $3 billion in our UMA program.
Right on.
Nice. I think I participated in some of that global natural resources back in the day, since we might be talking about the same shop. So maybe just off of that then. So when you're building these sub-advisor top models, other firms have, they do sometimes things similar to this. What sets it apart, I guess, from the institutions that, say, Wellington would compete against? Like what are they doing and what are we doing from this perspective that's different?
Great question. I think, again, in my experience, a lot of the programs, and I think of our program before we took it over, would tend to have more of a domestic bias, meaning a lot of Canada in it. And honestly, when we looked at programs and ones like these, we think you should have a more progressive asset allocation, and that really means more global, better diversification is one of them. We also take an independent approach. So we use active and passive. And again, we'll use active managers where they can prove they consistently beat their benchmarks after fees. And otherwise, we'll go passive and keep costs low. So again, a healthy mix there. And again, I mentioned the sub-advised portion is we are not forcing an internally managed product. You have to be in there on merit. And if a manager is not pulling their weight, we'll replace them.
Right. That's kind of good. I mean, one of the things that we're finding with alts is there is a larger American presence to some of the ones that we use or that we have available. Tends to come with a lot more disclosure, a lot more stability. When we started kind of in the alt world, for us, you start with a lot smaller Canadian firms that are very niche and have a very limited maybe accessibility to the things they need to build their portfolio. So it's kind of been not a Wild West, I guess, type thing, but it's been a bit of a different ride, and you're getting some better options, I think, overall at a lower cost.
We found the same challenges when I think of our program before. There was a focus on maybe, fees and again, finding some of those domestic alt managers specifically. We've actually flipped it the exact opposite way. We want fewer but deeper partnerships. And we've actually managed to get exclusive arrangements with some of the world's largest asset managers, and BlackRock, Goldman Sachs, and most recently Apollo. So again, true iconic brands in asset management.
Perfect. Tyler.
So obviously, today's environment and marketplace is causing, I think, a a lot of people being driven to exploring what the alternative asset world looks like. You guys would probably be in agreement with that. There's comments around the 60-40 portfolio being dead, that you just can't have 60% equities and 40% fixed income products, that you need to look beyond that. And that can be seen even and what turned Dave and I onto it back in the day would have been looking at just, for example, how the CPP was constructing their portfolios, 10 years ago and their exposure to alternative investments and private placement type stuff. So maybe you can share with us a little bit about, your belief around that as well and what's being created in the IAS platforms.
Absolutely. I kind of mentioned a more progressive asset allocation, and I think for all intents and purposes, the 60-40 portfolio is dead. And there's a couple reasons for that. It's that we've seen a higher correlation between equities and fixed income. So typically, fixed income might act as a ballast in kind of troubled times. It really hasn't done that in the last 5 years or so. Matter of fact, I was just telling you, Tyler, that I just read a stat today that, the 60-40 portfolio has only returned a 2% annual return over the last 3.5 years. When you think of the S&P up 25+% 2 years in a row, that's a pretty disappointing return. Progressive portfolios have a healthy dose of alts. And again, maybe not for everybody, but large institutional clients, endowments, pension funds, they're more in the 30-40% range. Again, it's long-term capital, but again, our belief is a lot of those exclusive products, private equity, where, in some cases you needed a $10 million order just to, again, be eligible, have been democratized. And now retail channels, in our own, a $5,000 minimum for some of these fantastic products. So again, true believers, and these are low correlation products. So what they're doing for you is they're truly diversifying your portfolio, reducing volatility, and yet in a lot of cases, having returns that are comparable to other equities.
Yeah, I mean, we're on board. We have been for a while. It's interesting when you talk about the 60-40 and having horrible returns. I mean, part of the reason we started moving a bit this way was, a bit of equity replacement and a bit of fixed income replacement. So that's what changed our percentages. I mean, we'd be like a 50, 20, 30. So 50 equity, 20 fixed, and 30 alts. And just thinking of our earlier podcast today, talking about, kind of an alt fixed income, which is all fixed income, but considered an alt because of the shorting. And you're looking at, the yield is a completely different beast, but it yet invested in the exact same asset as a long bond fund. So it's just kind of neat when you look at something that brings a different, maybe a little bit different risk other than interest rate risk. It brings more compression risk on the spread, but yet returns are higher. And so the battle for the last 10 years has been getting something out of a fixed income that, covers the advisory fee. Like it covers the management fee, the advisory fee. Like what's the point? But you need the cement of a portfolio. You need a base. You need something that has low volatility. And that's the best thing I think about the alt world is you can find those, and some of them are liquid and some of them are not liquid. And so your risk changes into something else when they're not liquid. That's a liquidity risk and that's a different measurement. But I'm seeing even in that world of just straight fixed income, we have some things that we can tie into a traditional with something that's an alternative without really increasing the liquidity risk, which I think is kind of neat. So overall, just to comment on the 60-40 there. So we got a couple other questions on this, but maybe just a question. I mean, you're running IIS, which is a part of Wellington-Altus or a separate firm to Wellington-Altus. But would you say, when I look at and have other discussions with other advisors, different places, different firms, I would say Wellington's kind of embraced the alternative side of the world. I mean, if I look what's available to us, I can't imagine many other firms with something, I'd call it a product show for availability of different choices. We seem to have quite the broad spectrum of availability.
Yeah, I mean, we certainly do. And again, the fund being or the firm being founded on attracting independent advisors and offering choice. I guess, I'd say, yes, we have a very broad shelf. It probably gets broader. The nice thing is there is a product team that does the initial due diligence and ongoing due diligence. So, I mean, we vet these funds very carefully as well. So, when you're using something, it's been, again, a very thorough process of checking out the fund, the underlying process, the managers, and making sure they adhere to it.
Yeah, and we love those the pieces that we can get from the firm as well as our own research. Then you take it from the team that they have their own materials, which are very glossy and nice. Smash them all together. It's you can get some amazing information for, well, in our world, the know your product side of it, but for us just to even understand it and to make sure that we're comfortable with it to use for our clients.
It is a relatively new asset class, Canada. I mean, we're just over 5 years in terms of, I guess, when regulators allowed liquid alts to be part of the universe. It's been an explosion of different types of funds and alternatives, and some that enhance yield, some that are just about reducing volatility. So again, a lot of different places to help construct portfolios.
Awesome. I guess, so what's in the funds that we have available and that you're working with, what is the tactical strategy around how to use them, or what are the managers that we're using through IS? What are they all about?
Okay, interesting question. I mean, we certainly have the liquid alt solution, which is really premised on our solution. It's sub-advised by BlackRock, again, world's largest asset manager, over 16 trillion Canadian in assets. Just to put that in some context, the entire Canadian, investment universe is valued at about 6.8 trillion. So truly a global titan, a lot of expertise there. The solution we went with is, again, a liquid alt that uses a variety of equity neutral hedge funds, top-down macro, and alternative credit, really to provide you low correlation with stocks and bonds, and yet at the same time targeting a 6 to 8% absolute return. So regardless of what underlying markets are doing, this is kind of doing its own thing. Besides the liquid alt, and again, we do have a few others in the UMA as well for some variety, but I'd say that's the flagship. Tactical strategies are something new, and I'd say people are a little less familiar with, and really in volatile markets like today, they're also very well suited, because when you have your strategic mix, you have an underlying tactical component that takes that 3 to 12 month view, and then will shift the portfolio very efficiently between, asset class, so stocks or bonds, by country, and even down to sector. So again, there are a variety of tactical funds out there. Ours, also sub-advised by BlackRock, has an incredible track record of providing, again, another unique source of alpha in how they make these calls. So not only are they making tactical shifts, they've proven they do it very, very well. So again, a unique source of alpha and another differentiator in portfolios, and we found that it actually reduces volatility overall.
Great. I think, it's kind of what we try to do with our all portfolios as well. I think what you get a lot of pushback on these days is there is no active management that can beat just buying the index and the passive. And if you were to just compare the two straight up, maybe you would say that the passive in most beats the active. But I think we're not talking about risk-adjusted returns here or anything. A lot of people just, maybe you want the cheapest thing and you're going to go passive. The problem is they can't stay in it long enough to get the return. Like, they'll bail when it gets volatile. People are out.
Yeah, that's a fantastic insight, because certainly the performance is one part of it. Statistically, over the last 15 years, 88% of active managers have not beaten the S&P 500. Interesting. And again, when I think of our models, our approach is similar. If I can buy S&P 500 exposure passively for 5 basis points or less, I'll do that all day. The caveats to that, I would say, are where you can find managers that can prove that they can consistently, after fees, beat the benchmark. And again, whether it's a style tilt, something that's more concentrated, some unique strategies. There are some that still manage to do it. I'll look at other categories like fixed income. And I think we've learned, when I kind of look at the past 5-year experience in particular, that is a place where you can benefit from active management. And again, in that case, the managers have been beating benchmarks even after fees, because they, turns out that maybe fixed income markets aren't as simple or straightforward, and whether you're taking credit risk or just rate risk, again, a good manager can navigate around that, where individually sometimes you really, again, don't have the insights into some of those markets.
Well, yeah, and what we learned too about the fixed income market in our last podcast was just about the strategies from an alternative perspective that can be used in there, where you're shorting one product and buying another. So that they're finding a way to create alpha and create growth with some of the strategies that they have inside of their pool, but not available in your traditional, mutual fund style investments. So that's where the alt
even like 1% of Canadians participate in, if that.
Yeah.
And yet it's you're going to get a bump.
Yeah.
And really with a different style of risk, but overall, if you're comparing complete risk, you're probably in the same boat, complete risk wise, but the return is going to be better and it's less volatile. When interest rates go to extremes both ways, you don't get the huge run up in the value of a long bond. You don't get the huge crash. I remember when I first came to business, 1993, everybody was piling into mutual funds. In 1994, we had an interest rate change and everybody in bonds lost some money that year. And everybody's like, I knew I should have stayed in GICs. Mutual funds suck, because a lot of people piled in 93 with the markets. And same goes with these types of things as people, in 2022, like if you had a 60-40 portfolio, you were double digits down in that year from both equity and fixed combined. And that's not what people expect when they have that kind of blend. So,
yeah, it's interesting how sometimes the pendulum swings too far. And you look at the growth of ETFs and passive investing. And again, we're not taking anything away from that. But when you find pockets or even periods where active management pays off, that's another level of diversification in a portfolio where, yes, people think of geography and asset class, and some of those things, management styles, but active and passive fits into that equation as well. And you want to have some diversity there as well.
Yeah. Same as what you're saying, ETF-wise. It's such an easy way to get into investing and get into the markets. I think there's a lot of people who are finding their own way into it because they don't know where to maybe find an advisor, or they don't think they have the right amount of assets for advisor. But someone who gets started into something like that's a great way, but that will also learn about volatility quickly. And for those who decide to seek more and more information, they'll start to figure out there's got to be better ways to kind of offset some of this. And I think that's, this kind of clients we end up with in the end, but there are a lot of people who are comfortable in that world and until they're not, and then they start looking for other answers. So it kind of, yeah.
And the passive market is easy to understand and easy to get into. If you're tracking an index, how it's simple, right? I understand what I'm buying, whereas maybe an alternative asset is a bit more complicated and you would have to go through an advisor to gain an understanding about it and place it into your portfolio and how it fits and how much to allocate to it. So barrier to entry is a little bit harder, I guess, on the active style and understanding what the active is. So
I think, and that ties back is, traditional 60-40 is not good enough. Tyler and I realized that lots of years ago, and that's why we've kind of blended things. Objectively, when we're talking with a client, it's like, can we get you the underlying return of the benchmark and get our advisory feedback to you? If we can do that with less volatility of the overall market, then we've met our mark, because now you're technically getting your advice for free if you want to look at it that way. But that's, if you buy just a straight passive fund, we'll take that fee and subtract it from the return of the index. You won't get your index return. There's just a cost.
I think maybe people, when times are good, people tend to maybe neglect the volatility aspect of it. But I think of year to date this year, people got a very fresh reminder of what negative volatility means and maybe the value of advice and how to properly construct a portfolio.
Yeah, I think of all our discussions, we're here middle of April and when we look at our client portfolios, because we've had a few discussions, obviously, like everybody in our industry, I think we're -3 to -5 on the year. And that's because of the allocation that we talked about, how much it can save a portfolio.
The S&P is probably down close to 10%. Maybe it's rebounded a little bit lately, but
except for today. So that's we'll say you're down. It's down even more.
Yeah, pick your day.
Good question here, because this is something, we have a discussion about the liquid alts and the liquid alts. And, when you're even just talking about alts with your clients, it's like, well, it's basically anything that's not liquid. So stocks and bonds trade daily, they're liquid the whole bit. But then you're like, but, things like Bitcoin, it's not a stock, it's not a bond, but it trades every day, every second, the whole thing. So there's kind of this mishmash of that. Maybe just give us a bit of a take on your sense of what should be in a portfolio, liquid alts, non-liquid alts.
I think both, because I often get asked the question of like, if you had to pick one or the other, liquid or illiquid, the reality is a liquid alt is designed, even with low correlation or to enhance returns, it does to some extent rely on underlying markets to a degree. I mean, I think the experience we've seen is that everything gets taken down. Even some alts that normally have low correlations get taken down a little bit with that. And I think the reality is the fact that you have daily liquidity is an advantage for most people. Now, if you are a very large family office, a very large client, if you compare the two products head to head, I think you would go with the illiquid or semi-liquid one all day because you're diversified. You're not exposed not only to, when I think of the S&P 500, you look at some of the reasons why private equity, for instance, is so popular. It's market volatility. A lot of privates have, even a third of that volatility. When you look at returns, you can get similar, even better returns. People might be surprised to know that the long-term returns for the S&P 500 are 10%. So again, in private equity, you tend to have returns at that level or even higher. And then there's the concentration risk we've seen. Top 10 stocks in the S&P represent 34%. So we're seeing concentration levels we haven't seen. So you don't have the same level of diversification. And the other reality is over the last 30 years, the number of stocks in the US has shrunk from 8,000 to about 4,000. They're private. So you actually have less choice. 90% of the businesses in the world are private. Only 10% are public. So you really are diversifying, again, the source of return. And in most portfolios, that is a key advantage.
Yeah, I can think of when we had something worth more than 10% in an index. We go back to the Nortel days. If you're a Canadian, what was it, 30 something of the index back then, maybe on more.
And we all know how that ended, including with the new listing.
And Briex kind of added up on that side too. But that's a long time ago. That's Canada. But when we talk to our clients, and once again, if we're running a 30% all portfolio, we're probably 60% are illiquid and 40% are liquid. And kind of when you have that discussion, you're okay with that. 60% of 30 is 18. If you're talking to a client that have $1 million, you say basically there's 180,000 that would take us 6 months to a year to get at. Are you ever going to be cashing this whole portfolio in at once? And it was like, no, never. And in reality, of all the years we've been advisors, nobody ever comes for the full portfolio in one shot. Now, if they ever want to transfer somewhere, well, you make sure you got to transfer to someone who can handle those alts and things of that nature. But generally, that's not the risk to the client overall. I think part of the illiquid side that we need to talk about is that it could be gated. And I think this is something that's left off the table a lot, or just you throw the word gate out and you leave it there and let your clients figure out what a gate is. But I mean, in reality, if the world goes to pot, everybody wants to sell everything, regardless of what it is. They sell their fixed income too. I mean, they're out, right? So this is where your illiquid assets will be gated if that situation came along, and you won't be able to get at them. And 9 months later, when they let you get at them, you've made 6% return, and you're lucky and happy you never got out of them, type thing. So
I agree. And a part of that is the due diligence of the manager. The size of funds certainly matter, number of positions. But it is a reality in privates that is a possibility.
Yeah. Doesn't happen a lot, but it is a possibility. And I'm talking more obviously in the extreme situation. I mean, if we hit March 13th, 2020, who knows what, we didn't really have anybody kind of back at that point. It didn't matter what you had. I mean, if someone's panicking, they're going for this. But in the long term and the way you look at the world, most of the people we're talking about here are dealing with an advisor in some capacity. It's very hard to get at these alts without using an advisor. So, if you're an individual investor and you don't have a $20 million portfolio to buy into some of these, you're not going to worry about this whole situation. But usually you should have an advisor who's explained this and kind of built your portfolio to accommodate the fact that there might be some of this illiquid portion, and in the worst case scenario, some potential for gating. And that's the discussion that has to be had.
Interesting. I could think of, I don't do a product promotion here necessarily, but we just launched with Apollo, again, one of the largest alternative managers in the world, and by far the largest in alternative credit. Their flagship fund that we actually have exclusively are offering in Canada now, it's a $20 billion fund. And interestingly, when I think of Apollo has about $13 billion of their own capital in that fund. So they are contractually obligated to stay in the fund. There are other large institutional managers. So you have about 80% of the assets in that fund that cannot redeem. So when I think of, we're offering quarterly liquidity. So I think for our retail investors to get into that fund, I think that, the possibility of gating certainly is, I think, remote, but does exist. But I feel a little bit better that you have this massive fund, and there's a lot of liquidity available there.
Awesome.
Mm-hmm. Well, we touched on it briefly at the start of our conversation that alts are attracting a lot of attention right now. Why do you believe private markets are getting all of this attention? Why there's all these new product launches, a lot of new stuff becoming available to retail investors? What's driving that?
I think it is a bit of a conundrum. There has been, with low rates, there's been just a lot of capital. We've seen it. We've seen public markets certainly bid up. A lot of money still on the sidelines today, a lot of liquidity, and that's transferred into privates as well. So I think you do have to, again, pick and choose carefully in terms of the type of strategy that the manager is following. And this really comes to, are they overpaying? Are they over-levering? Are they all chasing, a fewer number of companies? That is certainly a possibility, I think, in the background. So I think the due diligence is, what's the track record? How do they select? Are they a little bit different than maybe some of the mainstream managers? The funds of funds is another thing, buyout funds, how much leverage is employed. And I think the type of market dislocations we're seeing today, that's where, again, when the tide goes up, again, we'll kind of see who's wearing a bathing suit, because if you're levered up to the max, well, we've seen what's happened with rates. And now you get some concerns about some of the underlying companies, because a lot of the premise for some of the companies is you buy a private company, you lever it up, you cut costs, and you're hoping that 5 years down the road, hence some of the illiquidity, 5-year, 7-year lockups, is they need to sell it at a higher price. Mm-hmm. That doesn't always work out. So again, that's not the type of strategy our manager follows. Yep. If anything, they're the opposite, where they've got dry powder and they're waiting for these types of market dislocations to get better pricing and allocate capital.
Well, once again, I keep referencing back to discussions we have with our clients, but when you explain what an alt is, obviously we're talking maybe the illiquid alts, like it's not a bond, it's not a equity. Basically, it's something that isn't traded often, and so liquidity is a bit of an issue. But in the world, because alts just means anything else. We like to say 95% of it's utter crap. And basically people who are kind of maybe not in the market per se, they're out there peddling stuff. People that get caught in the wrong things are being sold stuff that have no oversight and aren't even sold through normal channels. I mean, that still ends up being called an alt. But I think for us, what we vet through at Wellington, that's sort of, you're narrowing like this massive pool of alts that are available down to a very small amount that we're willing to use and to work with our clients with, and even the ones that IS is bringing forward for us to be used. I mean, that's the vetting process, and I think that's the part that is hard maybe for a client to understand, is what's been vetted through a firm and gets to whatever small list we have. There's so many others out there that will never even make it close to the list, but people are trying to sell to you as a bona fide investment. I'd always be conscious of that for clients with those choices.
Absolutely. I mean, part of our due diligence, not just the initial due diligence, it means meeting with the manager, having them ask an extensive questionnaire, making sure there is a track record. Again, some of the criteria set on that, I always get back to, sometimes a strategy, you want a strategy to succeed, and you kind of worry about performance. You don't want to worry about the manager keeping the lights on it either. So there are solvency checks, bankruptcy checks, there's other things you have to do before you partner with a firm or approve something on your shelf.
No, I agree.
All good comments. I think I'm got all my questions in.
Did you?
Yeah.
I unchecked almost 3 of them there, but I think we've commented. Anything you want to add that we haven't really covered that you think's relevant? Or
I think the one thing when I think of the portfolio approach, and I know you gentlemen are doing these portfolios, I just want to reiterate, a huge advocate of alts because of what they do for portfolios and kind of modern portfolio theory. You learn from the experiences we've gone through, and I think when I look at markets now, and some of the dislocations, some of the volatility we're facing. It'll be a great reminder of people. I can think of not long ago, U.S. exceptionalism is a term you get thrown on a lot of people saying, all I need to own is the U.S. market. And again, the U.S. markets are the broadest, deepest, most liquid in the world. And we all know that. And AI is a huge theme. And we've got these, great, magnificent 7 stocks. People, and again, a couple of years of the S&P doing 25% plus, people sometimes need to be reminded that you still need diversification, that you can not only be in one market just because of the recency bias, and a well-constructed portfolio, the value of advice, and with modern portfolio theory, with alternatives, tactical, will just benefit clients.
Very good.
Yeah, good points. Well, thanks very much for being here, Mark, and joining us on Smokin Bulls. If you guys want to learn more about us or about Mark's products, certainly get in touch with us. You can find us at towerwealth.com. Follow us on our socials. Click to subscribe so you guys get all these videos in the future. And thanks for watching. Bye for now.